that now. We've got another guest to give us an insight into the global market, global investment trends. We've got asset management strategies implemented abroad and an outlook on the global markets. We've got Haywood Kelly, Head of Global Research at Morningstar Inc. Haywood, thanks so much for joining us.
Thank you.
I know you don't look too much at the Indian market, but you certainly do look at flows. So what's going to keep flows coming to emerging markets in India especially? Because we've had a great year for the last 6 months as far as flows are concerned.
That's right. Yeah, there's a lot of interest out there in India right now. With the change in government, there's a lot of excitement about that. People see the next 10 years as possibly being a repeat of what we've seen in China the past 10 years. So there's a lot of excitement about possible deregulation. So there's a lot of interest. In emerging markets, the past few years have not done so well. And so there's also interest from value investors looking at emerging markets in general as a good place to put money.
Okay, so is India also benefiting from this sudden, almost the death of the oil market, the collapse in crude prices? Because it's possibly one of the emerging markets that will benefit the most from
Absolutely, that. Yeah, I think it could benefit a lot. And China, on the contrary side, with commodity prices down, a lot of people are souring on China, so it's helping India.
Haywood, hi. Afternoon. So what is the pecking order looking like in terms of investment trends, say for the next 6 to 12 months? Which are the markets or the countries that top your list?
Yeah, that's a great question. I'd say the developed markets look fully priced at this point. So the U.S. had looked cheap in October. We had a dip, but the market has bounced right back. So I'd say emerging markets actually look pretty attractive. And if you look at PE ratios, you look at valuations, emerging markets would be a place I would be looking at. Fixed income is also a little scary. We're seeing a lot of flows into fixed income. Investors are looking for yield, looking for safety, but with interest rates in the developed world so low right now that it's a little bit risky. So emerging markets would be a good place to look.
So developed markets are fully priced. You look at emerging markets, but within emerging markets as well, India is already up 35% this year.
That's right.
While peers like Brazil, Russia are all degrowing this year. So do you get a sense that this outperformance of India could continue despite such a big run?
Well, I think it's always tough to say if it's going to outperform over the short term. I mean, emerging markets are all over the place over the short term. But if you're looking to invest for 5 or 10 years, absolutely, it would be a place to look. You just have to stick with the downtimes. The downtimes will come, the markets will fall, but you have to be willing to stick with it and even invest more when a market is down.
Okay. What are the innovative asset management strategies that you have abroad? I mean, in terms of, what is the allocation that you're looking at in terms of equities, gold, fixed income? How did that play out?
Right. Well, a lot of what's happening, particularly in the developed markets, is strategic beta or smart beta. And what that is asset managers taking a look at what's worked on the passive side, low cost, very transparent strategies, and carrying that over to the active space. And so you see a lot of strategies, say, that used to be the privilege of hedge funds, so derivative strategies, and also active equity strategies being implemented with a passive vehicle with rules-based, low-cost strategies. And so those assets are flowing into those vehicles. So I think it's great for investors to be able to get exposure, active exposure through very low-cost vehicles. So I would expect that trend to continue. And I think you'll see that pretty much across the world. It's a big trend in the U.S., but you'll see it in India. You'll see it in other markets, I believe, as well.
So can you elaborate a little more on what these equity strategies are?
Yeah. So, for example, you could take a look at high-income stocks or high-quality stocks. And so if you define those up front and invest in those in a rules-based way, say rebalance every quarter, you don't need an active manager there making the decisions. You set up the rules in advance, and it gives you a discipline going forward and a very transparent, easy-to-implement strategy. And this can be offered for 50 basis points as opposed to an active manager who might be charging 1 or 2% for a very similar strategy. So it's a way for the investor to get access to basically active management at a much lower cost.
Okay. Is that proving popular?
Absolutely. When we look at flows at Morningstar, we're seeing a tremendous flow to these kind of strategic or smart beta type products. I'd say fixed income and this and strategic beta are two of the hotter topics right now.
Just for the benefit of our viewers, can you explain to us what is the quantum of funds that you manage and how much of it is allocated to emerging markets, if anything at all?
Well, at Morningstar, we cover for investors about 3,500 funds globally.
Okay.
And a good portion of those are outside of the developed markets. So, either managed in the developed markets in the U.S. or Europe and invest in emerging markets or in the emerging markets. So a good number. And then Morningstar also in our advice unit, will invest in fund of funds, kind of best of breed money managers, many of which focus on emerging markets.
How's policy going to be affected in the U.S. by what happened last week in the election with the Republican getting ahead of the Democrats? Is it going to lead to paralysis? Is that going to affect growth? And if that affects growth, what does it mean for flows into emerging markets?
Yeah, that's a great question. So I'd say whenever you've got a split between the presidency and Congress, as you do today, don't expect much to change. So there's going to be, I would guess, gridlock for the next 2 years.
Mm-hmm. Would business look at that as good, because given that it looks at Obama slightly suspiciously?
That's right. I think it probably would be looked on favorably, that there probably won't be much active regulation going the next two years, or additional regulation. Mm-hmm. You might even see a little bit of a rollback or less emphasis, say, on the big Dodd-Frank legislation that's actually still being implemented in the U.S. So, it could be positive for growth in the U.S., but, the U.S. market, given how well it's performed, a lot of that is probably priced in to the market in the U.S. Okay. So I wouldn't see it having a big effect on emerging market flows or...
Okay.
So what are you going to impact emerging market flows?
Well, commodities for one, just the performance as well. I mean, unfortunately, investors invest in emerging markets when the performance is really good. Unfortunately, that's probably not the best time to invest. I think it's really important for investors to focus on sticking with it and invest more when emerging markets are down. If you kind of pursue that disciplined strategy with emerging markets, you can make a lot of money over the long term. It's the people who just chase the hot returns that don't do so well.
Okay. And finally, if you just want to elaborate a little bit on what the mutual fund trends have been up until now and what the global trends will look like for the next, say, 6 to 12 months?
Yeah, well, like I said, fixed income is hot. When we look at flows, fixed income flows into active funds, passive funds has just been tremendous. I mean, people are looking for yield because interest rates are so low. We've been at a 30-year bull market for bonds and a big trend in lower interest rates. So people are really struggling with how to find income and safety post-financial crisis. So I would imagine that's going to continue. But when it turns, when interest rates we start on the uprise, which they will at some point, it'll be very interesting, perhaps scary, to see what happens to those flows into fixed income at that point. I would expect that to continue, and there's just a big trend in passive investments in general, whether it's into open-end mutual funds, ETFs, and I would expect that to continue. I mean, overall, it's a very big positive for investors because you're getting access to a lot of great strategies at low cost, very transparent. So, cost. We found when we study mutual funds, the number one determinant of future performance is cost, the expenses an investor is paying. And so if you can keep those expenses, that's the one thing in an investor you absolutely have control over. You can pick the low expense funds. So if you stick with those, you're going to do okay.
All right, we leave it at that. Thank you so much, Haywood, for joining us and giving us a sense of what global investors are up to at this point in time. Well, that's the word coming in over there.